Hey everyone, Eric Walters, Managing Partner at Summit Hill Wealth Management, where we'd like to help you savor life's best moments. So, if you haven't noticed, markets have been volatile, and I'm getting a number of calls from concerned clients. And if you're having a hard time with the volatility in the market, I want to offer 5 things that finance and science tells us can help you deal with those anxieties. All right, let's get started. The first one comes from the field of behavioral finance and psychology, and that's the idea that when we are afraid of something, it tends to be more of a vague kind of sense, and you can almost imagine it kind of back in our mind. Now, if you know the different kind of areas of the brain, you know the kind of base of our brain is kind of basic survival. Those are kind of automatic functions that happen. We're kind of going to jump away for something scary or move our hand away from something hot. And then we have kind of mammalian brain. This is more emotional intelligence. This is kind of basic needs. And then we have like the prefrontal cortex. This is like the executive function and what we think of as kind of reason. Now, when we're afraid of something, often it's kind of back in one of these kind of more subconscious or even unconscious areas. And so what we've learned is that if you take out a piece of paper and just write down what you are afraid of, I know it may sound a little hokey, but it actually works. Just write down a list of your fears and just start the list with, I have fear that blank. I have fear that blank. And it may be, I have fear that I won't be able to retire, or I have fear that I won't be able to enjoy my retirement, or I have fear that this thing could happen politically, or that thing could happen to my family member, that person that I care about. And what research has shown is that if we start writing our fears down, it moves it from that, more subconscious into the conscious. And when our prefrontal cortex can actually see it, we actually say, oh, there's only 6 things that really bother me right now. It's not 100. And when I see them, they seem less gargantuan. They seem less overwhelming. And it allows me to start to brainstorm and say, maybe there's specific things that I could start doing to address that. Maybe there's people I could talk to answer this question. Maybe there's resources I could learn more about. So that's the first thing. Write down those fears. Right below it, what I would encourage you to do is to write down periods in your life where you've, as an investor or as a professional, experienced market volatility. And I hear about this all the time from clients. They'll say things like, I remember where I was in October 1987 and the market was down quite a lot. Or I remember what it was like going through the tech crash of 2000, or I lost my job in 2008. So I want you to write down those difficult experiences and then also write down how you got through it. So it was difficult at the time, but now it probably doesn't seem as pressing. You're probably saying, it was a difficult time, but I did get through it. We did get through it. The portfolio got through it. So that's the second step. Write down how you as an investor and also you as a professional have got through difficult times. And it starts to remind you that this too shall pass. That the markets and kind of upheaval in the economy and in the political situation, that's fairly normal. And just kind of saying, okay. So those are the first two steps. Write things down. Write down fears. Write down how you've gotten through this in the past. You'll feel amazingly better if you just do this. The third step is get educated and change your scope of reference. And what I mean is current headlines like to pick out the most negative, scary framing. And if you know the phrase framing, it's how data is presented. And the current framing is, the S&P 500 is down 11% from its tippy top that it hit in February. Now, if you change the framing a little bit and I say, well, the S&P is down 5% year to date, oh, well, that doesn't sound quite so bad. And what if I tell you the S&P 500 is up 28% cumulatively over the last 3 years? Oh, well, that feels a little better. And so change your framing and be aware of the long-term data. The stock market over the last 14 years, if you have a diversified portfolio of international and diversified stocks, is up about 8 to 8.5%, depending on, your frame of reference in terms of your start date and exactly how you calculate that. But that's a lot of money. From the last crash in 2008 until now, the stock market's approximately quadrupled. So, okay, that's a pretty good framing. And if you think about how often stock markets go down, that kind of interim 10%, it's about once a year. And you're usually back to even within 3 months. That feels pretty good. And if you would have invested $1 in the global stock market in 1970, and terrible things would happen since then, right? You could imagine the wars oil embargo, you've got terrorist attacks, you've got, depending on your political views, good and bad things happen in different administrations. Smart and bad people are in power. Smart and stupid people make decisions. And then you've got crashes, right? You've got the crash of 2000, 2008, you've got COVID, you've got 2022. And yet that dollar invested in the global stock market became $80 at the end of 2022. So change your framing, think about data, and think about how resilient markets have been in the past, okay? The fourth step that you can take is create a customized financial plan. It's important that you look at your own finances. If you look at your own finances, your nest egg, your amount of savings, your individual investments, if you do that with a certified financial planner who can create a long-term financial plan for you, it can give you peace of mind that markets have been volatile. They will be volatile, but your financial plan should be able to be stress tested. We do this every year with our clients. We invite them in, we look at this long-term financial plan, and we stress test it. And this, can be higher inflation. It could be kind of higher taxes. It could be market declines. So create a financial plan to know that you individually and your path right now that you're on is appropriate for you, and then stress test it. When you see the stress testing results, you say, oh, okay. My plan for the future is going to be okay. And when you look at your investments, this brings us to the fifth step. It may mean that you should do some rebalancing. I frequently see when I'm talking with new clients, they'll say something like, well, I feel a little silly showing you this, but I have this one investment and I didn't touch it since 2003. Or I have a concentration in this stock or this ETF and it hasn't been doing well. And so this is a little bit like going to the doctor and the doctor says, well, you're in okay health here, but this one thing we need to work on. And so work on it. So maybe you do need to rebalance your portfolio. Find a qualified professional to help you look at your portfolio in the context of broad history. You don't want someone that's going to try to get you into the next hot stock or, here's the next, kind of pump and dump on some Bitcoin meme coin. What you want is a disciplined approach to reach your financial goals. And that may involve some house cleaning, some spring cleaning. Then as you're rebalancing, you should be aware that there are some great investments that are not simply stocks and bonds that tend to move in opposites to each other. There are great investments. We use many of these for our clients, like private equity, where we invest in the stock of private companies. Historically, it may grow faster than public stock. Private credit, where we lend money directly to private companies. Right now, those funds are yielding kind of 9 to 13% per year. Then also managed futures. This is a trend following strategy that can trade the market and profit when the market goes up and when it goes down. We use a very conservative one that has consistently earned about 7 to 8% per year. Now, whether these are appropriate for you depends on your circumstances, but we like to use them for clients. And if you start layering these into a portfolio, you get a more resilient, robust portfolio that can produce good returns even in these difficult kind of situations with the market and political situation. So that is your 5 steps to dealing with investing in volatile markets, especially if you're having a hard time, if you're dealing with anxiety or fear. I understand. I'm a professional investor. It happens to me. But write down your fears. Write down instances where you and your loved ones have got through difficult circumstances. Change your frame of reference. Think about that data. If you don't know it, contact me. I love talking about financial history and I'll give you all the data. Build a financial plan and stress test it. And then think about you may need some rebalancing and think about those tools that can help your portfolio be robust and resilient. If you're looking for a second opinion, be happy to chat with you. You can instantly message me here or you can email me at info@summithillwealth.com. Happy to take a look at your portfolio, offer you some ideas and thoughts about how you can savor life's best moments. Have a great day.